Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to Friday. This is the final Money Talk of the week on the 5th of May. And this podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, the European Central Bank raised interest rates by 25 basis points as widely expected on Thursday, signalling a slowing pace of policy tightening from consecutive half-point rises this year. Borrowing costs in the 20-country Eurozone have now reached their highest level since July 2008, following 7 consecutive rate increases, as the ECB strives to combat high inflation despite ongoing recession risks. The Hong Kong Monetary Authority increased its base rate to a 15-year high of 5.5% after the Federal Reserve raised its key interest rates by 25 basis points. It marks the 10th straight increase over the past 14 months here in Hong Kong, and HKMA Chief Executive Eddie Yu warned local interbank interest rates would rise further, and Mr. Yu also cautioned against excessive optimism over rate cuts later this year. Following the latest round of monetary policy tightening in the US and Hong Kong, the biggest commercial banks in Hong Kong said they will raise their prime rates by 12.5 basis points as soon as today. HSBC and its subsidiary Hang Seng Bank will raise their best lending rates to 5.75% starting today. The Bank of China will rise on Monday also to 5.75%. Standard Chartered and the Bank of East Asia have decided to raise their prime rates to 6% from Monday. Beverly Hills-based PacWest is the latest US regional bank on the brink of collapse and is weighing up its options, including a sale. Shares of PacWest plunged over 50% on Thursday on reports that it's considering a breakup or a capital raise. PacWest has about 70 branches, primarily in California, as well as about $44 billion in assets. PacWest said in a statement, it's been approached by several potential partners and investors in a bid to secure a financial lifeline. And it added that these discussions are ongoing. On today's programme, I'm joined by Francis Lun, the CEO of GEO Securities, and Carlos Casanova, Senior Asia Economist at UBP. With a view from Australia is Toby Lawson, Director at Statton Advice. And if you want to get in touch, please go to my website, which you'll find at peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street Thursday, US stocks closed lower for a fourth day as fears over regional banks escalated. The renewed declines in the banks came after news Wednesday that California-based PacWest had been assessing strategic options, including a breakup or a sale. Shares of PacWest plunged over 50% in New York on Thursday. The KBW Regional Banking Index fell 3.5% to close at its lowest level since November 2020, and that index has lost 35% over the past 3 months. Arizona-based Western Alliance plunged over 38% and trading was halted several times. Memphis-based lender First Horizon saw its shares collapse 33% after Canada's TD Bank shelved its $13 billion acquisition of the lender. Zion's Bancorp lost 12%. The woes in the banking sector dragged the broader market lower. The S&P 500 slid 0.7%, closing at 4,061. The Dow fell 286 points, or 0.9%, to end at 33,128. The latest decline turned the Dow negative for the year on Thursday, pulling back 0.1% year to date. The Nasdaq Composite shed 0.5%, ending the day at 11,966. After the close, Apple reported second fiscal quarter earnings that beat Wall Street's expectations, driven by stronger than anticipated iPhone sales. However, Apple's revenues shrank for a second straight quarter compared with a year ago. Total revenues fell 2.5% year-on-year to $94.8 billion, driven by steep declines in sales of Mac computers and iPads, while net profits were down 3.4% to $24.2 billion. Shares of Apple rose around 2% in after-hours trading. Stock markets in the Asia-Pacific region were mixed on Wednesday after Fed Chairman Jerome Powell ruled out cutting US interest rates because he didn't expect inflation to come down quickly enough. In mainland China, traders returned from a 3-day holiday and sent the Shanghai Composite Index 0.8% higher to 3,350. In Hong Kong, the Hang Seng was 250 points, or 1.3% higher, at 19,949. The tech index climbed 0.5%. And this morning, futures markets are pointing to falls for Hong Kong stocks at the open. The Hang Seng is expected to start the day around 90 points lower. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's go and welcome our guests on this Friday morning. We have with us Francis Lun, the CEO of GEO Securities. Morning to you, Francis.
Hi, good morning.
And also joining us, Carlos Casanova, who is Senior Asia Economist at UBP. Morning to you, Carlos.
Good morning.
Well, as we heard there, the European Central Bank has raised interest rates by 25 basis points, as widely expected on Thursday. That signals a slowing pace of policy tightening from consecutive half-point rises this year. The interest rate on the main refinancing operations has increased to 3.75%. And borrowing costs in the 20-country Eurozone are now at their highest level since July 2008. That's after 7 consecutive rate increases as the ECB strives to combat high inflation. So Francis and Carlos, no surprise in what we've seen this week from the central banks. Both the ECB and the Fed have raised rates as expected. The thing is, though, markets are now betting that these rate rises are going to be taken back by July. And Fed and ECB officials are adamant that they won't be. So who's right here?
Well, I think the market is getting ahead of itself. I think the market practitioners have been too optimistic. I think the central bankers look at the inflation figures, seeing that they really haven't come down as much they want to. And of course, that is the still the grain deal between Russia and Ukraine hasn't been done yet. So if Russia would not go along, then the price of grain will shoot up. And then inflation will shoot up too. So we still have to wait and see.
I personally feel that the market is definitely getting ahead of themselves. The good news is in the US we are going to see a pause. So at least the pace of tightening on the Fed side is going to stop. The ECB was very clear that inflation is still too high, real rates are still negative, and conditions are still too accommodative. So they are, in fact, going to continue tightening going forward, at least, and we expect at least one more time this year before pausing. So, is that going to be enough to get inflation from 7% down to 2%?
That's a big ask, isn't
Probably not. So we are looking at some form of policy pivot in 2024. But 2023 is definitely a bit ambitious, especially given the drivers of inflation, which are core inflation and services and structural. And of course, with what Francis was mentioning of potential, upside risks on the geopolitical front in the months ahead, that would impact the headline number as well.
The ECB is further behind, isn't it, compared to the Fed? I mean, the Fed now has got interest rates. They had been negative. They're basically real interest rates are zero now, aren't they? Whereas the ECB has still got a long way to go.
That's correct. The Fed is ahead of the curve. I think the only central bank that has been more aggressive is New Zealand. So the Fed is ahead. They typically consider cutting rates when real rates are around 1%. And of course, the other side of the congressional mandate coin for the Fed is unemployment, and that has to be usually around 5%. So we do think that there's going to be an erosion in aggregate demand in the second and third quarter. In the fourth quarter, we'll have a better sort of idea, and then probably in 2022, the Fed will have those conditions in place to consider cutting in 2024. But for the ECB, they're lagging behind. We're talking terminal rate. The rates are still around or under 4% instead of 5.25% in the US. So they still have a little bit of a way to catch up.
And inflation's still climbing in the Eurozone, whereas at least in the US, although it's high, it has come off the peak.
Definitely. I think the number one factor is the price of gasoline is coming down. I think we see the crude oil falling to the $70 level, maybe down to the $60 level. So that accounts for quite a lot of the CPI. But I think the core problem is still rental. I think in the U.S., the rental market is still very, very tight, and rental prices are quite high. That is why the core PCE hasn't fallen yet.
What do you think could cause the markets to be right and central banks to have this sudden reversal that the markets are pricing in? Can you see any big risk on the horizon that could cause central banks to pivot like that?
Well, I think one reason could be the recession, looming recession. You see in the San Francisco and business centers like New York, the office vacancy rate is something like 10% or more, and that signal slowing corporate hiring. And that is not good for the economy, especially in Silicon Valley, where big tech firms used to hire many, many graduates. Now they're cutting people. That is quite a big change.
The Fed is almost expecting a recession, isn't it? It may not want one, but it's sort of expecting one. So presumably it would have to be more than just a mild recession to get the central banks to reverse. It's either got to be a deep one or maybe even stagflation. Would that do it?
Yeah, that may do. But if another bank failure comes along, then the Fed might have to do something else, and that is the other big risk factor in the financial market right now.
I think you're right. So the conditions are going to get tighter, even if the Fed pauses, and the reason for that is banks are going to adjust their lending policies, and so lending will be more restrictive. So we are going to see a tightening of credit, and that could be enough to push the economy into a recession in the second and third quarter. The last Fed meeting saw some discrepancies in opinions. The governors are still keen on the soft landing scenario, but some of the members are talking about recession. Nothing points to a worst case scenario that would cause the Fed to pivot in 2023. In my opinion, what it would take is a shock to the banking sector. So the current situation, which by the way is an ongoing structural issue with deposit rates versus money market rates, but I think they know this, and they have done their assessments and don't think it will be an issue. But in case there is a negative surprise and spillovers from one of these smaller bank defaults affect some of the larger structural or systemic banks in the U.S., I think that could potentially create conditions for an earlier than expected Fed pivot.
So could this banking crisis, if it escalates, be the thing that does it? Because we've had 4 regional banks now in the last few weeks go under. That's quite a lot, isn't it? And the 5th is teetering on the brink, and there could well be some others. You almost wonder, is there going to be much left of the regional banks in the US by the time this is over? It seems that their business model is just unsustainable in this sort of higher interest rate environment.
I think the FDIC must do something drastic now, like guaranteeing all deposits before another bank run. I think the problem facing Pacific West Bank is that the investors just lost confidence and take the money out. And no bank can survive a run on deposits, not even the biggest banks. So I think that's the problem of confidence.
I see it slightly differently, actually. I think when you can get a 5% risk-free return in money markets, why would you keep money with some of the smaller local banks that offer lower deposit rates?
Yeah.
That is something that is not easily fixed. Two things have to happen. Either profitability goes down because deposit rates go up in these small banks. They're paying more to the clients to hold deposits, or interest rates go down. And so given this conversation around core inflation, the second part of that equation is not possible. So what we are going to see is a decline in profitability for US banks and a tightening of credit conditions, that they have to readjust their risk management profiles.
I think why people kept put the money originally in regional banks wasn't because of the high deposit rates, because they weren't very high at all. It's because they got preferential treatment for loans, didn't they? They got things like mortgages at very cheap sort of rates. Right. So that sort of kept wealthy clients at these banks. But going forward, that's not going to happen anymore. So what would be the rationale now of a regional bank like that?
Well, That's a U.S. tradition that you bank with your regional banks, and that's why the U.S. has many more banks than other developed countries. There's a problem from history. Most other countries, you only have about 10 major banks and very few regional banks. But I think that we have to change. I think a big consolidation is underway in the U.S.
Yeah, I agree with Francis there.
What about here? The Hong Kong Monetary Authority has increased its base rate to a 15-year high of 5.5%. That's the 10th straight increase in rates here over the past 14 months. HKMA Chief Executive Eddie Yu warned that interest rates are going to rise further, and he also cautioned against optimism over rate cuts. And following that, local banks raised their prime rates, all by 12.5 basis points, either from today or from Monday. So what is going to be the effect here of rising interest rates? They're getting to more restrictive territory now, aren't they?
Yeah, definitely. I think the first thing that will be affected will be the property market, mainly the mortgage market, because the mortgage rates are now approaching something like 4% now, much higher than last year. Last year you have about, I think, 2.5%, something like that. So people will have to pay much more interest right now, and that will have a negative effect on the property market.
Yeah, I think property is one thing. Of course, there's been a 7% rebound in home prices this year. On the back of that reopening narrative and expectations that demand would pick up massively. I think you have to separate different segments of the real estate sector. So those that cater for real local demand, of course, will suffer, because with mortgage rates being so high, a lot of people are not going to be willing to pay, above bank valuation for their homes. So definitely some downside risks there. Maybe not so much on the investment type properties, given that there's a bit more connectivity between mainland and Hong Kong. And the other area that I would watch, of course, is interbank liquidity. The current situation of the HIBOR-LIBOR differential, with the LIBOR being around 5.5 and the HIBOR remaining stubbornly low at 3.6. Hong Kong may blames low credit demand, but I think part of the reason is also excess liquidity that they haven't been quick enough to mop up. So that situation is not sustainable. So we are going to see tighter liquidity overall in Hong Kong. It's either that or we have outflows for the first time again, if that fuels a protracted carry trade on the Hong Kong dollar.
There's still quite a big differential, isn't there, between HIBOR and LIBOR? So presumably that aggregate balance could go to zero, could turn negative. What are the implications of that?
Well, but the chief of Monetary Authority played down on the risk, because I think Hong Kong still has a lot of liquidity in backing deposits. The loan-to-deposit ratio is quite low compared to other major financial centers. So, and of course, Hong Kong government has still have an enormous reserve to back up the Hong Kong dollar.
He was saying, Eddie Yu was saying, that even if people are selling the Hong Kong dollar and converting it into US dollars, they were still keeping those US dollars in the Hong Kong banking systems, and therefore liquidity wasn't actually exiting Hong Kong. Do you think that's the case? Is that true?
Well, if they want, they can sell the US dollar into Hong Kong dollars. if they wanted to. If they want to, yeah.
But also, it's slightly counterintuitive, isn't it? The reason why you would convert your money to a foreign currency is because you want to take it to that country.
Yeah, but that is the problem with the fixed exchange rate. Yeah.
We are seeing some arbitrage opportunities with the current imbalance between HIBOR and LIBOR rates. The money is indeed not leaving the system, so no problems there. But of course, whenever the Hong Kong dollar hits the weekend of the band, they do have to use foreign reserves to support the peg. And that situation, although they have enough foreign reserves, is not sustainable forever. So with there being a new set of priorities and it no longer being as important to keep housing prices inflated forever, I think that the Hong Kong MA has an incentive to mop up liquidity. I think we are going to see interest rates go up, and we are going to see tighter credit overall in Hong Kong as a result, like we are seeing in the US.
Tell me your thoughts about Hong Kong's economy, because we've had data this week. First of all, the economy expanded 2.7% year on year in the first 3 months of 2023. So we've exited recession. We had 4 consecutive quarters of contraction. We also had retail sales data. It jumped by a record 40.9% in March from a year ago. So it looks like we've been exiting a recession on the back of a spending boom.
Well, I think the biggest constraint in the Hong Kong economy now is the labor force. Compared with 2018, Hong Kong's labor force actually shrank by 400,000. That's more than 10% down from 5 years ago before the riots and things like that. And just over the last 2 years, the labor force shrank by 150,000. So the airlines are saying that we cannot increase flights out of Hong Kong because we just don't have ground staff, not pilots, but ground staff. So I think the government must do something like maybe import 50,000 people from China to ease the temporary labor shortage because it's hindering the basic services. So that is one for the government to do something.
Not sure how easy it is to import 100,000 people.
Well, the government can do anything now. It's not like before.
It's sort of defying gravity, isn't it? Because people seem to want to leave and not actually come here.
I mean, the first half is clearly going to be consumption-led recovery. We saw, in fact, tourism numbers overshoot pre-COVID levels during the Golden Week holiday. They were 65% of pre-COVID levels during March. So you can, and retail sales were around 30% in the first quarter. So you can only expect that the contribution of private consumption in the second quarter will be very elevated. We do expect to see our performance in the second quarter as a result. But how long does that last? What we want to see in the second half is a broadening of this economic recovery, a more lively IPO market, a more lively real estate market. And unfortunately, it looks like that part of the equation is going to be more complicated. So we do expect to see economic recovery pick up from 2.7%. It's going to be a relatively good year. But if you look at some of the forecasts out there, you have the consensus is around 3.7, and expecting that we are going to go from 2.7 to 3.7 on base effects alone in the second half. And then you have some of the more outlandish names, some of the more aggressive US banks that I will not mention, claiming the economy is going to grow 6% this year.
Wow.
So I curb my enthusiasm for the time being. I think we need to see some broadening of the recovery in the second quarter before we can assume that we are going to grow above 3.5 this year. For the time being, I would sort of stay towards the lower end of the government's forecast.
Those base effects that you mentioned, I presume they've had a big impact because the situation a year ago was just so dire, wasn't it, that you're comparing this quarter to, that it's not a surprise that GDP has rebounded. It's not a surprise that retail sales have rebounded. They almost couldn't go down any more than where they were a year ago. So presumably that's a big impact, but it's a sort of one-off impact.
Yeah. I think as you go forward, I think the rate of increase will fall.
I presume also Hong Kong's now is coming out of recession at a time when you've got other headwinds now. You've got slowing world growth. There's tightening credit overseas. That's all going to act as a drag on the local economy here.
Yeah, definitely. I think tight credit and also you look at one thing. Apple reported slower sales because the slowdown in the sale of smartphones. Actually, this year, sales of smartphones is down something like 15% from last year. So, which means a big part of the consumption, electronic products, is slowing down. That actually caused factories in China to shut down. And then you have all these handset suppliers like Sunny Optical and Foxconn, etc., reporting very poor results. That part of the equation, the export growth from China, from Chinese factories in particular, has not really picked up, and this is a big worry for the Chinese economy, and in turn it will affect the Hong Kong market.
Yeah, correct. I think the external front will remain very weak. I mean, the Hong Kong business cycle is more linked to the Chinese economy than the U.S., but China is not impervious to deeper recession in the U.S. So we have that to look forward to. Definitely negative contribution from net exports. The other risk that I would highlight is geopolitical risks. It's proving incredibly difficult to instigate demand for Chinese risk assets amongst international investors in the current environment.
Yeah, Americans are not buying Chinese.
No, the risk-reward proposition is just not attractive enough. So we need to see a very strong earnings-driven cycle in order to entice international investors to buy Hong Kong equities. So, it's probably not going to be a super stellar second half, and that's going to drag as well.
Yeah, hopefully the investors from the Middle East will pick up the slack from the Americans.
Tell me what you think about the mainland Chinese economy. We've had manufacturing slip into contraction. Both the official PMI and the Caixin PMI confirm that. However, tourism's rebounded over the 5-day Labour holiday. Number of domestic trips rose by more than 2/3 from a year ago, and it's now back above pre-pandemic levels.
Yeah.
It seems, doesn't it, that it's a rather uneven recovery on the mainland, being driven by services like tourism, like catering, eating out, but manufacturing's in the doldrums.
Yeah, well, manufacturing is really more tied to the export market, which is slowing down. But hopefully, the officials are counting that domestic consumption, especially tourism, will pick up the slack for the economic growth. And some people were predicting maybe 5.5% growth this year. And if they can achieve it, that will be good enough.
But can this keep the economy growing, Carlos? Because tourism and related sectors, it's about 4.5% of GDP. So without this, what happens?
So currently we are in a period of strong but uneven economic recovery, led by consumption. And I would take that a step further and say that it's led by consumption of services, even over consumption of goods. Naturally, manufacturing is not great, both because of the external pressures that Francis was alluding to, but also because the domestic investment cycle is still very weak. And of course, people are consuming services, not goods. So the manufacturing will remain weak for the first half. There is some hope that looser credit conditions, in particular faster credit growth in the first quarter, will translate into a pickup in investment, but it takes a few quarters for us to see that. So by end of Q3 and Q4, we should see the broadening of the recovery from consumption of services to some investments as well. But we are inevitably going to see a slowdown. We're going to see a faster Q2, thanks also in part to a base effect. And then in the second half of the year, we're going to see a slowing of GDP growth to around 5% from what we expect will be a very good 8% recovery in the second quarter. And all of the Golden Week figures seem to point in this direction as well.
Are we going to see more policy stimulus, do you think?
100%.
In what form?
Not the time to be complacent for the PBOC. I think they outlined it for us very clearly during the National People's Congress. So RRR cuts remain a preferred tool. We could see 50 to up to 75 basis points in RRR cuts. They've been very active in injecting liquidity in the system. They've been pushing the banks to extend credit more aggressively. And I'm going to be a bit counter consensus here and say that asymmetric rate cut is still a possibility if we see manufacturing indicators decline more rapidly in the second quarter. It's not going to be a big rate cut, but it will be an important signal to the market that the government is not looking to stop supporting the economy just because there's a rebound in service consumption. So I think it's important for them to make that message very clear.
Okay, well, thank you both very much. Great to hear your thoughts this morning. As always, that's Carlos Casanova, who is Senior Asia Economist at UBP, Francis Lun, who is the CEO of GEO Securities. I'm joined now by Toby Lawson, who is Director of Statton Advice in Sydney, Australia. Morning, Toby.
Good morning, Peter.
So we've had a set of rate rises this week, some expected, some not so expected. Certainly the Fed and the ECB rate rises, 25 basis points, both well priced in. Australia surprised, though, didn't it, raising interest rates 25 basis points when it's sort of been signalling it was going to pause.
Yeah, it was very interesting and very much surprised the market. Almost 90% of, if you reflected in futures prices, would indicate there was going to be no move in rates. And this was after the Reserve Bank had previous month paused on raising rates. And subsequently they raised them 25, caught the market off guard. Aussie dollar rallied, financial stocks got hit a bit. But what was most interesting was, as you said, was the expectation in the market was driven by the Reserve Bank's commentary. And subsequent to that, what they saw and what they alluded to was that in that pause, you saw the banking crisis in the US start to ease off, but I think that could be a debatable topic that we could discuss, and that housing prices in Australia had started to peak up again. So there was a concern, I think, of the Reserve Bank that the message, or at least hadn't got through, and that the economy was still chugging along, and that some of the inflationary pressures driven by consumer demand and potentially in house prices was starting to peak up again. So it caused them to make a move to sort of maybe put another hammer into that type of sentiment in Australia. So it was a real surprise.
I'm wondering, we spoke last week about the restructuring of the Reserve Bank of Australia and the criticism that it's faced because it was too slow to raise rates. And in fact, for a while, it was predicting rate rises weren't going to rise, interest rates weren't going to rise until next year. I'm wondering how much that was in the back of the mind of the RBA, and they didn't want to get caught out again and be accused of being behind the curve.
Well, I think it's a good point, and I think it feels as if the Reserve Bank can't take a trick at the moment. Politically, publicly, everything they do seems to be against public sentiment and against the government. And I think the government have politicised, to be fair, in a sense. The Reserve Bank is a bit of a scapegoat for what's happened. Having said that, they haven't been good, I don't think, in their communication, the Reserve Bank. But I think to the extent that I think in history, some of these tightening cycles do have pauses in them. And I think a lot of the misread by the market was that the pause meant the end. And I think this is going to be a similar case with the Fed. I think the Fed, when they raised 25 and said this might be towards the end, it's possible that you get a pause and then another cycle. Mm-hmm. And it's historically that can happen because what happens is inflation tends to be stickier than what, suddenly it comes off in terms of base effect and it comes off in terms of some of the headline indicators, but ultimately it stays up. It forces the central banks to take another go at it. And I think that's possibly what we're seeing here.
And of course, over in Europe and the US, Jerome Powell is saying that, he was signalling, wasn't he, that maybe there was going to be a pause there, although he did emphasise that that wasn't the decision that the Fed had made. The ECB clearly has got to go further. It's behind the curve. But what they were both adamant about is there are not going to be rate cuts, which is not what the market is saying. The market is now pricing in that both the Fed and the ECB are going to take back these rate rises by July.
Yeah, exactly. I think this is a clear message, and I think this is fairly clear from what we see is that rates are going to stay higher for longer, and quite possibly you're not going to see them come off. They're potentially going to have another hike cycle if inflation persists. Now that'll be driven probably by the depth of any recession. So that happens in the second half of the year if it does at all. So the idea that a soft landing is a good thing potentially counterintuitively could lead to higher rates because what will stop the Reserve and central banks hiking rates is a sharp recession. if a slow recession or a soft recession, it might actually mean that they keep their foot on the rates for higher and makes you go into a second cycle. So I think it was a clear message from the central banks is that rates are staying high, even if we stop hiking.
And, of course, the other thing that could cause central banks to suddenly lower rates is a crisis of some sort. And the thing that stands out is this banking crisis in the US. We've had 4 regional banks fail now, 3 in California, 1 in New York. A 5th one is teetering on the brink, and it looks like there may be others as well. Could this be the thing that forces policymakers to change their mind?
Well, I think what's most fascinating about this particular banking crisis is the fact that it hasn't gone away and how quickly it can move. And this is part of the digital unintended consequences of digital banking to a large extent, that deposits can be withdrawn instantaneously. And I think, ironically, I think it's one of the things the regulators had not picked up on, that this a bank run can happen so quickly. So you saw last night, I think it was PacWest or whatever, or First Horizon, the stocks were down 50% overnight. And the ability to withdraw deposits instantaneously is creating effectively the contagion effect, because depositors can move quickly. Before, as they say, the old days, you had to line up outside the bank to take your money out. Now it's a click of a button. And so the risk on this type of contagion is that it moves very, very quickly. And so watching it overnight and watching it this week, it certainly raises concern that it's something that's almost impossible to control from that perspective, short of stopping people taking money out of banks. There's only so many times you can pass a bank off to JP Morgan or the other big banks in that sense. So yeah, it's something to watch, and it's actually a function of the change in way banking is done and the digital economy, which is exacerbating this problem.
I suppose though now, when you've had 4 banks fail and more sort of on the edge of the precipice, it's no longer an idiosyncratic problem, is it? There is something systemic now that you have to look at in the regional banking model, and it looks like maybe these regional banks, their banking model just can't survive this era of higher interest rates.
Well, actually, I think it's identified an idiosyncratic risk in banking. The idea that the banks could have prudential amounts of liquid assets and what have you, but the idea of being able to control deposits or having a view on deposits being sticky is no longer relevant in the digital world, right? So I think this is the idiosyncratic risk that's been identified in this whole thing, and it's exactly the issue now. Is banks' models relied on stable deposits as being a function of banking. People, most people who deposit money don't move it. And they leave surplus in there. Now it's much more mobile. And so it changes. This risk is now completely different structurally in banking than it was identified by what's happened. So it is quite a fascinating topic. And does that mean regional banks can survive in terms of the business model if they're reliant upon a narrow depositor base and one that's homogenous, right? Which you saw with SVB. You saw that they were all startup type depositors, large cash balances sitting there, but were able to communicate almost effectively with each other instantaneously to withdraw, and that's a big issue. And
it's one that's going to obviously continue into next week and over the weekend as well. We'll see where we stand on Monday morning on that. As you say, this is spreading so fast. It's almost like it's spreading across Twitter, isn't it? So Twitter's bringing some of these banks down. You could almost argue. I say that a little bit.
Well, and the sharks, absolutely. You're right, Pete. It's Twitter can drive it, and this is where you get the nefarious elements of the short sellers driving this type of panic. And you saw it when Credit Suisse went into the deal with UBS, that there was an attempt by the short sellers to put Deutsche Bank on the chop as well. Didn't work. But this is the downside of this thing, is that suddenly the Twitterverse or the social media can suddenly become actually a nefarious bunch of characters trying to bring down banks, ironically. So it's an interesting area, and one we'll be definitely interested to watch over the weekend.
Okay, and we'll talk more about this next Friday. I want to completely switch countries. Go to India, a country you know well because you lived there and worked there for quite a while. We had data out from India. It showed the services sector grew at the fastest pace in nearly 13 years. A lot of that's being driven by tourism. There's been a real boom in airline travel on the Indian subcontinent. Air traffic surged 96% in January. The nation's carriers have ordered more than 1,400 aircraft. Toby, this is something that's going to be an ongoing feature of the Indian economy, isn't it? It's going to become one of the major tourism markets and certainly one of the global airline markets in the world going forward.
So, in fact, it's most fascinating. In my time in India, I never saw an empty plane. And many flights going on domestically, even during the pandemic, because there's such a demand. So the likelihood it's the domestic market in and of itself that's going to drive the growth of airline travel and domestic tourism more so than international, because they have such a big population. And you can sort of draw a connection maybe with the US over the long term. If you I think I saw that story from BBC that said 456,000 passengers flying in a day in India. Well, I think in the US it's 1.7 million. And there's 25,000 flights versus sort of 3,000. So India has still got a long way to go. And the issue for India is that it's inevitable that's going to happen because, you can look at the stats in China as well. The numbers are off the charts. So inbound from outside of India is probably less relevant in a scale context to the actual domestic market, which is huge and only going to get bigger. The issue, of course, is India is infrastructure. And you mentioned the amount of planes they need to order. So double the amount of planes, I think, that are available for commercial flying, plus airports, connectors, all of those things. And that will probably throttle some of that growth. But it's inevitable you'll see a massive increase in airline travel in India. And, of course, more and more people outside of India travelling into it. But it'll be primarily driven by the domestic market.
The statistic that I found interesting was India, which has just over 1.4 billion people, has only 700 commercial aircraft. United Airlines alone flies more aircraft than that. So as you say, there's an opportunity here for massive investment, isn't there, in infrastructure, new airports, runways, buying new aircraft. This presumably could be an interesting investment theme.
Well, interestingly, one of the names that's been sort of negative in the press is Adani. And Adani own quite a lot of airports in India, and it was one of their investment theses to buy into airports. So, they've got control over some of the larger airports in India. So even though they've been on the nose in terms of the company as a group, their airline business looks like it's a potential winner.
So given that, I find it odd to hear that Indian Airline Go First has filed for bankruptcy. It seems almost impossible for any Indian airline to not thrive at the moment, although it was blaming failed engines from Pratt & Whitney for having to ground a lot of its flights. But this all seems very odd.
Well, I think in my experience, I think these countries, there's some good airlines and some not so good airlines. And in India, you had Vistara, Indigo, Air India, some very good brands that do very well, but also, Go India, Spice Airlines, a few others.
Jet Airways.
They're second tier. Jet Airways, some of them are probably, they're in the competition, but like with most of those type of businesses, scale and capacity drive results. And I think a lot of them are still trying to get enough scale to be able to compete against some of the bigger airlines. And hence, you can have much more vulnerability to issues around engines and capacity and things like that. So it sounds surprising, but it happens. Even in good times, companies go under.
I suppose in the case of Go, I mean, it's an ideal opportunity for someone else to maybe take it over and revitalise it.
I'm sure that'll be gobbled up by one of the bigger players easily, yeah.
Mm-hmm. Well, Toby, it's always good to talk to you. Thank you very much indeed for that. That's Toby Lawson, who is Director at Statton Advice in Sydney, Australia. Thank you very much for listening this morning and this week. Don't forget to look at my daily newsletter, which you'll find at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then are Alex Wong, Director at Alex KY Wong Asset Management, and Frederick Chu, who is Managing Director at Magnum Research. With a view from mainland China is Ben Cavender, Managing Director at the China Research Group. Have a great weekend.
Money Talk